Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Kristian Kerr, back from the massive LPL Focus Conference. A lot of people showed up this year, Kristian, huh? How was the vibe out there in San Diego?
It was great. A lot of upbeat people, obviously with the markets at all-time highs, but exhausting as well, but the good kind of exhausting, but was able to get some rest over the weekend and really ready to hawk some markets.
Excellent. Yeah, I'm sorry I missed you guys this year, but there's already some talk about 2026. I guess that's back in San Diego again. So, for those of you listening or watching who are out there, hope you had a wonderful time. And hey, we'll start prepping for next year, maybe in about 6 months. But we got a lot to do before then. So let's get to it. You see those disclosures. Here's our agenda. I'm going to recap last week. I think the most interesting thing about last week was the dynamic between the CPI and the PPI. Next, Kristian, you're going to walk through kind of a volatility outlook, I guess I'd put it, looking at sentiment, seasonality, and positioning. Then next, the weekly market commentary is on earnings. We'll, of course, follow up with a preview of Jackson Hole for the week ahead. There's also some earnings, but I think Jackson Hole is probably the biggest focus of the week, unless you want to make the case that the Zelensky-Trump meeting today is the biggest event of the week. Certainly that matters quite a bit too for markets and otherwise. So let's start with the recap, Kristian. I'm hoping you can help make some sense of this CPI PPI dynamic because CPI was better than expected and markets rallied. PPI was much worse, but the market didn't really sell off all that much.
Yeah, it was a little bit of everything, right? I would frame it that you got what you wanted out of the data. I don't think it changed many people's minds, right? I think the bigger kind of question mark for the markets right now is, did we see front loading of the tariffs, over kind of call it in the spring, early summertime, and is that going to, filter through to the data or not? And I think we're still questioning that. I think last week's data, like I said, you got a little bit of both, so we're still kind of um, in this mode of did that have a material impact on the economy or not? And we're still trying to figure that out. And I think that last week's data kind of didn't really shed too much light on that.
Yeah, you probably also have a market that realizes that the CPI and frankly the PCE inflation metrics matter more than the PPI. You could also make a case that the PPI is a signal of inflation that's kind of bottlenecked and that's coming later. But that's consensus, right? That's consensus that we'll get a little bit more inflation over the next couple of months. So I think the other story last week that was interesting was healthcare with the Buffett and I guess Tepper stakes in United Health. United Health was up double digits. A lot of talk about healthcare being a bargain as a value play. It has been terrible this year, right? The only sector down through last Friday's close. By the way, it's August 18th, 2025 as we're recording this in the afternoon. Stocks aren't doing much today, but yeah, healthcare is showing some life, Kristian. Your thoughts?
Yeah, I mean, listen, I'm a big believer in following positioning, and I was kind of getting to big extremes, but I think the question mark now is, is it just a short squeeze or is there more to it? And I think we'll know over the next few weeks. Clearly the Tepper and Buffett news helps, but I'm not sure that's a catalyst that can really, completely change the sector just because you have two important buyers in there. So I think it's still TBD, but something that was, for me, not completely unexpected, just given the positioning dynamics and that were so extreme, right? That it doesn't take much to kind of ignite a spark, which we saw last week. But I think still up in the air whether we're gonna, get a more material move here after that positioning dynamic has been cleaned up a bit.
Yeah, it certainly fits with the broadening out narrative that a lot of people are talking about, right? The stuff that hasn't been working has been bouncing a little bit lately. It's fits and starts, but I would
Yeah.
say consumer discretionary kind of fits into that as well as healthcare. Healthcare with policy risk, consumer discretionary with tariff risk. Those have been dangerous places to be, we'll say this year. International got a boost from the weak dollar, and then I guess maybe a peace dividend or speculation anyway. to that effect with the Trump-Putin meeting on Friday, which, the media outlets said it was constructive, but it's not really clear if any progress was made toward a ceasefire or even better, an end of the war. Yeah, Japan makes some news last week when that market hit an all-time high. Thoughts on those markets, Kristian, non-US?
Yeah, no, I mean, I think it's the potential for a peace deal is definitely, bolstering international markets, Europe specifically. Uh, we didn't really get much from the Friday meeting other than, some talk that it went okay, but I think really the market's going to want to see Zelensky, Putin sitting down together because that's been, told we've been told many times that that's really kind of the real thing that needs to happen for us to see kind of a real accord. So a lot of this I think is just kind of hope, but clearly moving in the right direction. I think that would be a big positive for Europe. Bigger picture, I think too. Kind of going back to what we're talking about on healthcare and now kind of international doing what it did last week. It's just tough in the dog days of August to really kind of latch on to any of these moves because, a lot less liquidity in the market. These things can get pushed around a little bit easier. So it's tough to really say, hey, this is a a major regime shift going on here. It's mid-August, right? And typically this is not when kind of the major kind of moves really start. So I think that's kind of maybe weighing on people's enthusiasm for these things right now, particularly on the rotation dynamics. But listen, bigger picture, I think that what's going on with the negotiations, clearly stuff that's moving in the right direction. I think we continue to monitor it because if something does happen, we do get any sort of true accord. Markets will like that a lot, I think.
Oh, no doubt. And you'll probably see more weakness in oil, which we've gotten lately, down a little over 2% on crude over the last 5 days. The bond market hasn't really done much lately, up a couple basis points today on the 10-year, 433. Really, all the talk is just Fed's going to cut in September and probably one more time. Any other thoughts on the bond market here? Is it wait and see, or is there something else going on there, Kristian?
Yeah, I mean, I think when it comes to rates, a couple things I'd say. Yes, we're a 25 basis point cut is expected in September, but don't discount the fact that there's about a 30% chance of nothing being done and about 20% chance of getting 50 basis points. So quite a decent spread of what could happen. So I think that what that does, it sets up a dynamic where because we're not kind of at that 100% fully priced in cut, there's room to get some surprises here over the next kind of few weeks, whether it's data, the next payrolls release, whatever it is, that could easily swing market expectations. So, that's kind of what I'm more focused on in the rates markets. In terms of FX, the I don't want to sound like a broken record, but the dollar's up against kind of major support. It's been holding on. As long as it holds above there, it's tough to get too bearish, especially after the move that we've had. But I think a lot depends on what goes on kind of with the Russia situation, with what goes on with Jackson Hole on Friday. I think kind of the dollar is essentially waiting for a catalyst. But if it does break or hold support more clearly, like I said, that's going to have some major ramifications for a bunch of markets, just given the dollar is kind of the denominator of everything. So if we start to see kind of a clear trend develop there, I think it sets up some interesting moves in the rest of the second half.
Yeah, it's not the time probably to bet against the dollar and ramp up your exposure to international, at least not in our view, but certainly near benchmark makes sense tactically. So that's where we're at. All right, very good, Kristian. Let's move on. Volatility outlook, sentiment, seasonals, positioning, point to a pickup in volatility, maybe nothing dramatic. I'll steal your thunder. We're not calling for an imminent correction or anything like that, but there are signs that maybe this market's a little bit complacent. So you got a bunch of charts here. We'll do rapid fire. First is
Yeah, yeah,
50-day
yeah. I
rate of
just want
change
to
on the S&P. Yep.
Yeah, I just want to give kind of a quick lay of the land, right? And we've been, market's been on fire, but we're comfortable kind of not having to chase is kind of the case I'm really just trying to make. Could we see kind of a vol spike going into the traditional, late August, September, October window? I think it's higher probability the markets are probably thinking right now, and that's kind of the case I'm laying out. But One, I think in this post-COVID environment, we've gotten very used to kind of this buy the dip mentality, right? We get sell-offs and we come back very rapidly. But I think people don't realize that what we just went through in April was historic, right? And that's kind of the case I'm making here with the rate of change in the S&P. If you can see here, the 50-day rate of change was the third most extreme to the upside that we've seen in the last 20 years. And the only ones that were above, were stronger than this was coming out of the GFC lows and coming out of the COVID lows, right? And after that was what we just witnessed. This was greater than what we saw during Volmageddon in 2018, 2019. So pretty historic move. And what I would point out is that when you get these types of kind of major spikes higher after a big move lower, in 2020 we still had 8% correction after that bounce, then I think believe about a 10% correction a little bit later after making new all-time highs. So, you know, to discount any volatility, I think is a little bit of an extreme move, right? Because we are kind of in a dynamic where there's been a lot of catalysts for the market to digest, and I think kind of expecting more volatility as this plays out probably makes a lot of sense, and that's kind of what I'm just trying to show here.
Yeah, it's like the quake hits and then you get little tremors after, little aftershocks.
Yeah, it's a great way to frame it, I think.
Totally with you there. All right. Turning to positioning, you look at this a lot. I mean, from this chart, it looks like it's getting more toward a neutral place.
Yeah, yeah. So, position I think is really helped understand what's been going on in the market probably more than anything for me over the last kind of, 6 to 8 months. Really kind of, we saw aggressive de-risking with all the tariff drama in March and April. And that was in a position where, the thing to know about, and again, I'm looking at positioning here across kind of all investor types. So think, CTAs, hedge funds, systematic investors, also looking at retail investors, just kind of basically all the major cohorts that are important in the U.S. market. And essentially, what we saw is kind of going into those April lows, a major de-risking that put us almost at -2 standard deviations. And historically, when you get to those types of levels, your expected forward returns coming out of that are very, very high, almost double digits, right? So from a risk reward perspective that the chances of going higher versus lower are pretty good. Now, I think kind of that de-risking that we saw in the market that forced a lot of investors to start to re-risk as the market started to find a footing and start to move higher. So it was almost self-fulfilling in a sense. And now we're back to basically neutral or a little bit above neutral levels. And the expected return to start to diminish from these levels going forward, right? So kind of the moves that we've had have been very sharp, as I just talked about. But kind of going forward, that starts to, when you look forward, out a month, 2 months, 3 months, the chances of seeing kind of, more than 3% type moves, start to diminish quite a bit. Not saying it can't happen, but just from a position dynamic, looking back through history, it suggests that kind of going higher at the rate we've been doing is less likely. And we start to get kind of towards, 1 standard deviation plus, then actually it starts to flip and you start seeing kind of the potential to actually see kind of negative expected returns over kind of the ensuing few months. So important level here, but kind of, bottom line, I think where we are with positioning now, we've kind of seen the bulk of this kind of putting risk back on, and it's gonna be much more of a slog than we've seen given the dynamics that we came out of in early April, where everyone had de-risked and kind of had to put risk back on. That's pretty much done now, and I think just main takeaway is that expect kind of steadier type returns or slower kind of move higher than we've kind of seen over the last couple months.
Yeah, since this is more of a short-term indicator, maybe you end up getting through this weak seasonal period, getting a little more caution in positioning. At some point, September, October, then you reload and you can make the next move higher. That's maybe getting a little too ahead of ourselves, but that that setup makes sense to me. So next up, systematic investors. I guess you use that kind of synonymously with vol control funds. What's this telling us?
Yeah, I'd say ball control is a major part of the systematic investors, but I would include CTAs in there.
Right.
Some other
Trend
type of
followers.
systematic investors. Yeah, yeah. But this is specifically just vol control, and I've talked about them before, but to simplify, what they do is basically realize their actual volatility in the market. When that starts to get higher, they de-risk, which we saw, that sharp move lower you can see kind of in March and April. That was them de-risking as volatility started to rise. And then as volatility started to stopped going up and started to move lower, we've seen them coming in, putting more risk back on, and they're an important part of the systematic community. Estimates that they're about, they run about $1 trillion in AUM across vol control, so a very important element of the systematic cohort. And I think they've been very, very important over the last kind of, call it, 2 months, where we've seen kind of this just real steady bid in the market, where I think they're just being forced to buy in, kind of stopping in as the market moves up and volatility continues to decline. Key point here, though, is that they're starting to get the levels in terms of exposure where they're starting to kind of top out, right? And again, there's different various types of look backs, 1 month, 2 month, 3 months. So the longer term look backs still have room to go, but we're starting to get towards the tail end of how much exposure they can start having, start putting on. So I think, that's another reason, a little bit more, a reason to be cautious here, just given we've had such a big move. A lot of the main systematic buyers is starting to get close to levels where they're not going to need to buy as much anymore. On the flip side, I would say, another big important kind of actor, especially over the last year, has been, just corporate buybacks, right? And they went into a blackout window, and that started back up again, as earnings season kind of ebbed. That blackout window stopped, and we start to see corporate buying start to re-enter the market. Estimates on that are about $5 billion a day, roughly. And key point to know there is that August tends to be the month where they're the most active, the most aggressive. So it's almost like we're seeing vol control start to ebb a little bit, but now we've got kind of buybacks coming in. But that starts to tail off here towards the middle of the month as well, historically. So you're just starting to see kind of these natural buyers in the market are kind of starting to hit levels where they start to peel back some exposure, some impact on the market. And I think that tends to coincide with kind of just that period, August, September, October, where it tends to not be the greatest time for the market. And I think a lot of that is just these natural buyers in the market start to pull back going in this period for whatever reason.
Yeah, set up to be the biggest year of buybacks ever. I think I've
Yeah.
seen forecasts for north of 1.1 trillion. I believe we had a big buyback year at some point, not that big maybe, but in the 80s. And then over the last decade, we've maybe, I think, approached 900 billion to a trillion, but not 1.1.
Yeah. Yeah. No, we're on record for the biggest year ever, right? And I
Yeah.
think, yeah, one worth of $1 trillion. So it's kind of, yeah, which comes out to about $5 billion a day, I think. So, very, very important actor in the market. And given that whole dynamic where they have these blackouts, and when they go off blackout, you kind of know when to expect more of their participation in the market and when they're going to kind of pull back. So I think, having that knowledge helps from a short-term perspective. And just, again, August tends to be a pretty big month for them.
All right, next up, seasonality, which I alluded to earlier. I mean, this is the worst time of the year, the worst rolling 3 months. We're still in it.
Yeah.
What does how do you sort of tie seasonality together with positioning?
What I really want to do here was just take another look at seasonality. We've all seen the seasonality charts. We've seen the VIX chart. The VIX one's very clear. You get basically to the time we're at now, late August, and it just, you tend to see a spike higher in volatility. So I thought, let's look at it across different particular investment types, right? So we take the CTAs, mutual funds, the long short hedge funds, and retail. And retail has been very, very influential in the market of late. I saw a statistic earlier where they haven't had a net notional selling day since May, and they're averaging about $3 billion in buys per day during that period, right? So,
Wow.
uh, yeah. So I mean, retail's having a bigger impact. You can probably estimate about 20% of the market right now is active, kind of self-directed retail traders. And you can see they're kind of that light blue line, and you can see in August they're the only one really buying right now, historically from a seasonal perspective. But that starts to ebb, tail off right about now, right? And then they actually become sellers. Some of the watch, given that they have been the kind of one of the more important cohorts in terms of investor types here over the last the last couple months. So I think if they turn, then you've basically got a window here of a few weeks where basically all major investor types are selling, or at least kind of not buying. So again, it's kind of another seasonal take on this time of year tends to not be great. Another reason, we're comfortable kind of not really chasing the market here, just given the window we're going into from a seasonal perspective.
Yeah, it seems like a good time to listen to the market, follow the technicals, wait for potentially this market to roll over, and then think about getting a little bit more cautious. But we're just not there yet. We're 6450 roughly on the S&P right now. Certainly, I think better than most people expected, but the trend is still your friend, as they say. We're above rising moving averages, even the short-term moving averages, like the 20-day. That's a good segue to this chart.
Yep.
S&P 500 approaching warning area. I mean, sure, we have all these uptrends and rising moving averages and higher highs and higher lows and all of that, but you drew a channel here that suggests that maybe there's upside to 6,600.
Yeah, so this is the 1 year standard deviation channel, right? So kind of how that's derived is you take a 1 year linear regression, you slap two standard deviations above and below that. And on a simplistic view, it's theoretically 95% of the occurrences should stay within that channel, right? That's kind of a way to think about it. I like it for a couple of reasons. It tells you, I think it's a good metric to use for a market that's overbought, just because you're starting to hit the, statistically important levels that, suggest you probably shouldn't be up here this fast. And also it tends to be a pretty decent resistance level where it's really hard to get too much above that standard deviation line. It can happen, but it tends to, it's very difficult for it to extend too much beyond that. Another thing I would kind of show here is that, we got on the downside, we got to basically three standard deviations, and we have come all the way back from a three standard deviation move to the downside to testing, getting very close to testing two standard deviations to the upside, which in my mind suggests it's even more overbought than just the simplistic way of looking at it would suggest. So that line comes in like a little bit south, a little bit south of 6,600, so call it a little about 2% from where current levels in the market are. So again, just a warning sign that we've come a long way in a short amount of time, and I would think we start approaching that 6,600 level, just an area of caution, because we have gone so far so fast, and statistically, kind of this way of looking at the market tells you that it's probably a good area to maybe think about, you know, just being a little bit more cautious.
Yeah, and the way you've shown this chart, certainly 6,200 jumps out as a potential area of support. That's a level that Adam Turnquist has been flagging as well. So maybe you think about getting a little more cautious if we break down below that 6,200. But for now, it's hard to get too bearish on this market with the momentum that we've got. How about breadth, Kristian? Does that give us a reason to maybe be a little bit more cautious or not so much?
I think so. I mean, I think in this era post the pandemic, particularly, breadth has been taking no matter what it does, and it's considered bullish, right? Because we've had this kind of buy the dip mentality
Hmm.
where if you don't have good breadth, people just take it. Well, eventually they're going to have to catch up with the leaders, and that's a positive sign. And historically, the way I learned about breadth is that if you don't have good solid breadth on an up move, then it's a danger sign, right? I think what I'm trying to show here is that I took it a step further and I looked at the Nasdaq breadth levels versus when it's making new all-time highs and looking at that historically. And typically, and this is I'm showing the Nasdaq Composite, but I was looking at the Nasdaq 100, and typically that's around 75% of the index is above the 50-day when it's making new all-time highs, and we were at 40 in change when we first started making new all-time highs in the NDX, and we're right now right around 50. And that hasn't occurred very much. And when it hasn't been a particularly great sign. So just trying to flag there that there are kind of, this lack of breadth is not necessarily a good thing, and kind of warns maybe we'll get a corrective move. That the prior times it happened was in the late 90s and in the 80s, and big bull markets came afterwards, but we did get some decent corrections as that breadth kind of sorted itself out, or the lack of good breadth sorted itself out. So I think there, again, just a cautionary thing to be looking at, given that making new all-time highs on relatively pretty weak breadth, at least statistically, is a sign that a corrective move might be in the offing kind of down the road here.
Yeah, we have seen small caps bounce lately and outperform large caps. It's been very short, pretty modest, but that suggests that, again, maybe this market is looking to broaden out. We need the market to broaden out to be healthier. That's the way I always learned it too, Christian. A healthier market has better breadth, and you got to really have some more than just tech working. You got to have more than just large cap growth working. We'll see how it plays out, but yeah, right now not a very strong kind of underlying participation here. A story that's not new. So turning to sentiment here. So here, Christian, you've used, I guess, implied volatility, right, as a measure of sentiment. What's this saying?
Yeah, yeah. So, last week the 10-day implied volatility dipped below 10-day realized volatility levels. So implied volatility is what the market is pricing in, and realized is kind of, as the name suggests, what the market actually does or realizes. So implied falling below realized is a pretty strong signal that near-term fears of any sort of sharp, market sell-off have essentially gone away. They basically faded. So in other words, traders or investors aren't pricing in much risk in the near term. Whatever concerns may have been lingering, have been shrugged off. So it's really a sign that the market feels very, very calm, and perhaps too much so. And in my mind, is an initial sign of complacent sentiment in the market. Again, it's 10 days. You're looking at 2 week levels, so very, very, very short term. But just the fact that we saw that last week, and you can see kind of on the chart historically, when that does happen, you tend to get at least a kind of a near-term pullback. So it's just an initial sentiment indicator that suggests kind of implied vols. So the people that are pricing these in are feeling kind of very good right now, and oftentimes when this happens, it's an early warning sign that sentiment's gotten a little bit too extreme to the upside.
Yep, complacency appears to have set in, certainly based on the vol picture and frankly based on the tariff situation that's going to be a little bit tougher to manage over the next several months. So I guess this is same kind of concept, but longer term volatility reading.
Yeah, yeah. So, think about volatility. What's nice about it is it tends to be mean reverting, right? And I think that's where it's really useful from a market analysis standpoint. So I've found that historically, when you get 20-day realized volatility gets to less than half of 100 days. So think of short-term volatility is trading at half of normal or longer-term volatility. It tends to be a pretty decent sign that you're going to get volatility pretty soon. And you can see kind of on the chart, you can't see it very well, but kind of, we saw that in 2024, and then December kind of got that a little bit, where you kind of have these vol spikes after you got those types of levels. And right now, realized vol is right around 11, and the 100-day volatility is kind of mid 20s. So we're at less than half. We start to see kind of short-term vol start to move up a little bit. So an indicator that I use to tell me when to expect some vol spikes. Now, what makes this a little tricky is that 100-day vol is accounting what happened in April, which was just historic type levels of vol. So if that starts to roll off, we could see that 100-day vol come down. So it's the only thing that makes this a little bit tricky, versus kind of normal periods where you've had kind of a window where you didn't have these crazy vol spikes in between. But just taking it purely from a systematic standpoint, whenever you get short-term vol realizing at half of normal historical or longer-term vol, it tends to be a pretty good sign that a vol spike is coming. So really just trying to identify conditions where you could get a material uptick in volatility, and right now we seem to have those.
I find myself talking more and more like a trader when I listen to you, Christian, because I always think never short a dull market, right? Certainly a popular trading adage, and uh, I also think about how volatility is increasingly likely the longer you have calm, right? There's actually an economic concept. I'm not sure what you might be
The,
able to recall.
the Minsky moment.
Oh yeah, Minsky moment. That's right.
Yeah.
So,
Yeah.
it's kind of similar to never shut a dull market because you just have more time to create potential instability, not major instability necessarily, but you have the potential to create a little bit of instability the longer you have stability, right? So, certainly something not just for traders necessarily, but for investors to think about as well. All right, so now moving across asset, let's broaden out a little bit beyond just equities.
Yeah, real quick one here. Just really, a couple things I've noticed over the last few years, particularly when you get volatility in different assets, all moving lower aggressively at the same time. Uh, when you get that phenomenon, because sometimes you'll get just low volatility in stocks, but then currency vol will be high or fixed income vol will be high or whatever. But you get them all moving lower like this, it tends to happen before you get a vol spike, right? Um, so you'd rather see it kind of happening, seeing dispersion in the vol, and we're not getting it, which tells you there's a lot of correlation among assets, even though it might not seem that way. So just kind of another indicator here that you can see pretty clearly. I'm showing the move index, which is fixed income vol. Showing the JP Morgan volatility, FX index, FX vol, and then the VIX, and they're all kind of moving at the same type of rate lower, same type of clip lower. And like I said, just historically, when you get cross asset vol moving lower at the same time, and getting kind of the levels that we're seeing, basically, 1 year type lows in these things, going into the seasonal window, just be on alert for potential uptick in volatility because that's tends to happen before broader kind of spikes in volatility. You get this cross asset decline in vol.
Yeah, if we're going to get a vol spike in the near term, it's probably not going to be earnings related, I would argue, because we just got a really strong earnings season. So let's shift gears, talk about that. We
I
have
would, I would say, I would say, Book, you got Nvidia still coming up, kind of an important one. So,
fair.
right.
And if I mean, I wouldn't expect Walmart or the retailers to drive a big market-wide sell-off event either, but Walmart has made news by saying they're going to raise prices and drawing the ire of the White House. So sure, we could have a little bit of volatility, but I would argue when I think about volatility, I think about something closer to a market correction, a
Yeah.
10% drawdown. I could be wrong, but my best guess is that there's really nothing in earnings in the next couple of months that's going to do that. Maybe something in rates could do that.
Yeah.
Maybe you have some institution that gets in trouble. Maybe you have a sticky inflation and the Fed stays on hold longer. These are the types of things that certainly could cause a correction. But we're not there yet. So weekly market commentary on earnings. I'll run through these really quickly, and then Christian, you can weigh in at the end here. This just shows you the earnings growth quarter by quarter, and we're on track to do 12% in Q2. That is more than double the expectations at the start of earnings season. We thought the upside would be a little bit less as tariff impacts increase, but it really wasn't. We got typical upside, same kind of upside surprise that we've become used to over the last couple of years. Really impressive. About half of that 12% earnings growth is going to be from the Mag 7, assuming we don't have anything crazy from Nvidia. That is a lot. In fact, if you just look at it by sector, tech and communication services, and communication services is where Meta and Alphabet are. Those two sectors alone are 8.5 points out of the right now 11.6 year-over-year earnings growth for the S&P. So just huge impact from big tech. Here you see the earnings growth for big tech. Just 7 companies, right, grew earnings, big companies, but just 7 of them grew earnings 26%. The rest of the market, the 493, closer to 5. So this gap was expected to close. It really hasn't. It'll close in 2026. How much we'll see, but the capital investment from these companies just keeps getting bigger and bigger, and the market is not punishing these stocks yet. At some point it will, but not punishing these stocks for huge capital investment. The perhaps biggest surprise this earnings season, I mean, maybe the Mag 7 upping their CapEx is a surprise, but I would argue the biggest surprise is that margins have held steady quarter over quarter despite the tariff impacts. Not only are margins expected to be flat quarter over quarter in Q2, they're expected to go up in the second half. And the tariffs are only about 60% in, roughly. I think that's about consensus. Maybe 9, 10 points out of the eventual, I don't know, 15, 16, 17 points that we're going to get, still up in the air. But a lot of tariffs have gone in. A lot of tariffs are still yet to come in, and yet margins expected to go higher. These are probably a little too aggressive, but it still reflects optimism and certainly reflects the fact that companies have done a great job of managing tariff costs so far and finding other cost cuts, efficiencies, beating up on suppliers, whatever it is. Companies are doing a great job. And so look at estimates. So this here, I'll bring you in, Kristian. I'm frankly surprised that estimates have gone up, and it's not just traditional market cap weighted earnings for S&P 500 profits, right? Not just that. If you look at breadth measures, more companies have actually seen estimates go up than down. So would you say that that's real? Are you impressed by that? Or would you say that it's just a function of the bar being lowered in April from the tariff scare and it really doesn't mean a whole lot?
Yeah, I mean, I'm a little bit torn. I think the one thing that corporate America does is get more efficient, right? And that's been clear. So I think that's a lot of what we saw in during the kind of tariff trauma that we were experiencing was companies just figuring out a way, okay, we've got to deal with this environment. So I think part of this story is real. I think, one of the smarter uh, commentators on the market that I listened to was kind of flagging that in the middle of kind of all the turmoil, right? That this could lead to some really nice upside surprises kind of in the latter part of the year as that starts to come through. So um, you know, I kind of buy into it, right? I think that's clearly, a part of it. I mean, listen, I don't discount the idea that expectations are low, the bar is lowered. That's clearly a big part of a big part of the earnings game as well. But I think just in this particular instance, just given what we've been seeing, hearing on the earnings calls, corporate America has done a very very good job of kind of navigating this and basically becoming even more efficient than we thought they could be.
Yeah, those are the last two topics of our weekly commentaries. How have companies managed tariffs so well was last week. This week was an earnings recap. You can find both those on LPL.com. So we already mentioned Jackson Hole, Kristian. That's really the big event of the week, other than watching retail earnings, which are going to be impacted by tariffs. What are you looking for at Jackson Hole or anything else you want to highlight before we wrap?
Yeah, it's interesting because it's theoretically Jay Powell's last one, right? I mean, it probably will be.
Mhm.
And Markets usually hope for some sort of guidance, but historically, Jackson Hole hasn't really been a great place for it, other than when kind of the Fed is teeing it up and telling us, hey, expect something, basically the Fed likes to give very, very clear guidance, and so they tell us, it's basically, this speech is going to be important. We haven't really gotten that. So, I think there's a decent chance Powell offers an update on his policy outlook. But then again, it wouldn't surprise me if he doesn't, especially given it's his final appearance. I will say if you look at it historically, most Fed chairs use their last Jackson Hole speech to really to kind of reflect on the past and their role in shaping kind of their tenure there. So that's really what I expect to get from Powell. So I'm not expecting too much from Jackson Hole, just given it is his last kind of appearance there as Fed chair. So I'm thinking probably the most likely outcome is that we just get kind of a recap of his tenure and kind of the role he played navigating through things like the pandemic and things like that, more than anything that's going to move markets with respect to what's going to go on in September.
Mhm. Yeah, more theory and frameworks and all of that sort of stuff.
Yeah,
Not your typical post FOMC press conference, right?
right.
So I agree. He'll have to address it. It's whatever he says, it's probably not going to change the market's expectations of a September rate cut. I think the question is just what comes after that. So we'll be certainly watching for clues on that front. So with that, we'll go ahead and wrap. So really good stuff. Again, Kristian, as always, thanks for joining. I'm glad you got some rest after a tiring few days, inspiring and wonderful few days, but tiring. I
You know,
know.
no better place to spend your birthday than Outlook, which I did. So,
Very
uh,
good. Well, happy belated birthday, a special Kristian Kerr birthday podcast for you.
yeah,
So thanks all of you for listening to another edition of LPL Market Signals. Greatly appreciate your support. Everybody have a wonderful week, and we'll see you next time.
see you later.